All right, everybody, looks like we are live. Give everybody a few minutes to get logged in. Say hello. It is good to see you. It is Monday night. Letting the music play out a little bit. We've got a lot to cover. We're going to be covering financial literacy for business owners tonight. And yeah, we've got a lot to go over. So welcome for those of you who are joining me. If you're joining me for the first time, say hello. If you're joining me for the multiple-th time, let me go ahead and say hello. Let me welcome all of you. And tonight we're going to be covering one of my favorite topics around financial literacy for business owners. This was something that I ended up having to, in fact, I've signed probably more NDAs within the last, I'm not even sure, 3 weeks than I probably have signed all year. And it's interesting because there's a lot of business owners who are in a selling mood. And that's not a bad thing. That's actually a good thing. And that's good for you, especially if you're a business owner that is looking to expand. Where that's not necessarily a great thing, though, is when you don't really know what you're looking at. And anything that I'm going to be offering tonight is not legal advice. It's not tax advice, anything along those lines. But it is advice just for things that you need to consider. And this is why you have to have a bench, right? This is why you have to have other people in your sphere and in your circle that are going to be helping you, that are going to be looking for the things that you may not know to look for. Great example. In fact, several times I have looked at different businesses, and I have to be careful how I say this stuff because I did sign an NDA. If you're not familiar with an NDA, it's a non-disclosure agreement. So I won't be saying any names. I won't be saying any specific of companies or anything like that. So I'm going to keep this somewhat high level, and anything that I say today is actually going to be altered from what I actually viewed. And because there's legal ramifications, right? If I come in and start blabbing about the things that I saw and was really super specific about this city and this town and this business, well, that could put me in trouble with them. So not about that. Not to mention, these people, they need to trust. They need to have some level of trust that I'm not going to come on and blab about all their business, right? Because as a strategist, I get involved in people's lives at a very deep level, and that's really important. So I'm telling you this because if you would want that out of a strategist, whether that's me or someone else, you want to make sure that you can trust them. Because this is someone it's kind of like you're the president, and you need to have a chief of staff that you trust completely. And in some ways, I do act as that. So let's talk about a couple different things. So one of the things that I got in a conversation with today, in fact, it was twice today, I got into conversations with folks who were trying to figure out what's a reasonable purchase price for this company. And we'll say that the company is a lumberyard, right? So this lumberyard, we'll say it's in Wisconsin, is trying to sell this lumberyard. And the lumberyard does well, right? The lumberyard's been around for a while and it has sold well. But the biggest revenue increases have happened in the last couple of years. It was very stable the last 10 or so years. Not barn burner, but all of a sudden, the last couple of years, there's been significantly more revenue and significantly more profit. Now, you might think that's great. It would be, and it's not necessarily a bad thing, but it makes me wonder, what are they doing different? Are they now where before they taking out expenses? Are they running expenses ordinarily low? Is there a building that's going on in that particular area of Wisconsin that is just creating a temporary run up in all of this stuff? Or is this a result of their increased marketing efforts? They have a dedicated salesperson now, or maybe before they didn't. These are all things you need to think about as a strategist, right? As you're looking at overall at whatever business that you might be looking to purchase, or even your own business. This is all stuff that you need to start to think about. So it was interesting that we were looking at this, and I had to walk through again. In fact, I did this all month with people in context of what is known as EBITDA, all right? So EBITDA. And there's also there's other financial things too that that are, you know, in sorry, I've got people blowing me up here. So the the thing that you're looking at is, you know, what are these types of income that's coming in for the, oh my gosh, what is happening? There we go. So what is the type of income that's coming in for the business, right? Like what are these things, you know, what's going on with this? Like what are the things that are what's the money that's coming in, and what are they able to keep, and how much money is actually going out the back door with this with this entity. So that's what we're going to be talking about tonight. And I got a comment there. Let's see here. Oh, are you in sorry, I'm having trouble reading what you're saying here. This be okay. So you are trying to. Okay, so you've got a business in. All right, yeah, I've got someone messaging me here. All right, so you've got a business in. I'll tell you what, if you want to go over to the school community and drop in there, that's probably the best thing. I'm going to go ahead and put the school community in here, and that way you can just jump on over there if you've got a question, because I am really struggling to figure out what you're trying to say there. So there's that. Just head on over there. There's there if you're interested in checking that out, because the problem is this, right? The problem is you've got lots of different things that you're looking at in a business, and you don't really necessarily know what to look at. So there's things, basically most of the type of valuations that you're going to be looking at is going to be based on EBITDA. And EBITDA is it's a acronym. It's an acronym for earnings before interest, taxes, depreciation, and amortization. And why that matters is because it takes the taxes and depreciation and amortization. That's basically, they're basically called non-tax deductions. It takes the interest, taxes, depreciation out of that. So if you're looking to buy a business, that's really going to be important for you to check that out. All right. So that's going to be a couple things. Let's see, Stacy, you are saying, give me a second here. Sorry, guys. I'm having a heck of a time trying to see what it is that you guys are. Oh, okay. Oh, so okay. That's a good question. So you're asking about seller's discretionary earnings. All right. So if you're looking to buy a business or you're looking to sell your business, this is something called SDE. So a business valuation can either be based on EBITDA or SDE. It's probably more typical that I have seen in EBITDA, but I suppose that SDE can also be looked at. And that is also important, because SDE is kind of what the owner takes out of the business, even though they don't necessarily take that as a wage. So in other words, they might own, let's say that they own some personal assets. Let's say they own the building that houses this entity, the business, and they take rent out of the business in the amount of, say, $50,000 a month. Okay. So that could be a pretty sizable building that they own. It could be a giant warehouse. So they're going to rent that to the business for, say, $50,000 a month. And that $50,000 a month comes to them in the form of rent. And why would they do that? Well, if they are set up as an LLC, taxed as an S corp, that actually lowers their taxable income to the S corp, and it actually shifts that over to rental income under a holding company that owns the warehouse, right? That's pretty typical. Again, all this stuff you need to run past your accountant to make sure that makes sense for you, because if you own them both in LLCs, then it may not make sense for you to do that, right? So that's a really good point. All right. So what we're going to talk about, I'm going to go ahead and share my screen here. And so this is something that I do. The financial literacy for business owners is actually something that I do as an actual seminar. So I'm not going to spend the whole hour and 15 minutes that I do on the seminar here. But the financial literacy for business owners, this is really important stuff, because if you don't understand the balance sheet and income statement, this is going to be really hard for everything else because the business, the balance sheet and the income statement are foundational. So if you're trying to figure out, like, if I'm trying to have a conversation with you around EBITDA or even seller discretionary earnings, and you don't really understand how they calculate that number, then me telling you like, oh yeah, they're going to price that, they're going to evaluate that business on a 5 times multiple of EBITDA. You're not going to know. I mean, you're literally going to look at me like I'm asking you to explain Bernie Sanders. You're not going to understand any of that. So that's why I'm saying the financial literacy piece is going to be really important. So what I'm going to do, I'm going to skip down to the part in the session, and we're going to get to the financial statement piece, just so you can understand what the context of all this is. Because here's the thing: if you don't understand the balance sheet and what that represents, it's going to get really, really complex. So first and foremost, the balance sheet is primarily what it represents, the value of the company based on its assets and its liabilities. So, for example, what you own is your assets and what you owe is your liabilities. So if you're looking at that and you're trying to figure out like, okay, well, I own, say $10 million in real estate and I owe $7 million in the business in liabilities and mortgage debt or whatever else it is, the valuation is $3 million, right? 10 million minus the 7 million in liabilities is your $3 million in valuation. Now, that is what's on the balance sheet. That doesn't necessarily mean that that is what the business is worth, because the business may be valued differently, right? So let me go ahead and share the screen here, and that way you can see what the financial statements look like. So I'm going to show you the difference in terms of why the valuations on a balance sheet and the valuations based on on earnings that come through an income statement might be different. Okay, so let's go through the very basics of the financial statements first, just so I know you understand what we're looking at here. So from the financial statement perspective, this is where you're going to look at your balance sheet, your income statement, or P&L. By the way, if someone calls this an income statement or a P&L and they say income statement or P&L, they are the same thing. Or profit and loss and P&L are the exact same thing. It's just a different in verbiage. So for me, I'm an accounting purist, and I tend to use the phrase income statement. So that's important. Not really, but I just want you to know that the income statement and the P&L, they are the same thing. P&L, income statement, P&L, profit and loss, they all mean the same thing. So let's first look at the balance sheet. Balance sheet is what is owned by the company, right? Or owned by you. You can create a personal balance sheet. In fact, if you're going for a loan, this would be important if you know, right? So a balance sheet is what you own. The liabilities are what you owe to others, right? And then what's remaining is the equity. So that's what's worth on paper. So if you're, for example, if someone comes to you and they says that they want to buy your business, it's going to be pretty rare that they're going to look at the balance sheet and specifically make you an offer based on the balance sheet by itself. Not that you shouldn't look at it, but I'm just telling you that this is pretty typical. Like, they're not going to look at the balance sheet, but that does not mean that you shouldn't look at the balance sheet. And I'll explain why here in just a hot second. So let's look at the income statement. The income statement and the P&L, profit and loss, all same thing, right? They are made up of 3 parts, just like the balance sheet. Balance sheet is made up of your assets, your liabilities, and your equity. The income statement is also made up of 3 parts, which is your revenues, which is your sales. Like, basically that's what your sales dollars, your expenses, which is what you pay out in a given period of time, and your net profit. So 2 main considerations, 2 key differences here between the balance sheet and the income statement is the balance sheet is a moment in time. So if I run the balance sheet, and I'm going to go ahead and I'll show you this here just a second. I'll blow this up just so you can see it. But here's the thing: the balance sheet is made basically from a moment in time. And that's really important to know this, because if you don't know what time this thing is being ran, let's say for argument's sake that if I asked my bookkeeper to run a balance sheet for my property management business in the morning, and she pays bills all day long, that's going to look very differently when she runs the balance sheet in the evening. because all those transactions went in and out, right? That's why the balance sheet's going to look different. So it's in a moment of time. So generally, once all of the accounts on the balance sheet, like your checking accounts, your credit card accounts, all of your accounts receivable, everything is done and locked for that period, like for the end of the month generally, that's when you should print the balance sheet. And the accounts are locked, nothing can be done, nothing can be entered prior. Now, sorry, that is when you generally want to run their balance sheet and the income statement. Now, the income statement is over a period of time. So the balance sheet is always kind of like the period at the end of the sentence. Think of it that way. Whereas the income statement runs over a period of time. So the income statement, for example, that'll go from, say, like the beginning of January to the end of November. So if all the accounts receivable, like what is due to you, the credit card accounts, what you have to pay out to other vendors, right? They may have an accounts payable set up with you. All of those accounts, the checking accounts and so forth, all of that stuff's been reconciled. That means they check what is against what you say is in your ledger versus what they say is on the statement. So you just literally just go, yep, okay, yep, okay, yep, okay. Oh, that one doesn't belong there. Where does that from? Oh, that actually belongs in the checking account, not in the credit card account. That stuff happens all the time, right? Stuff gets misentered, or the credit, or worse, their credit card statement says, "Oh, there's a $5,000 charge," and you're like, "What's that for?" And all of a sudden, you realize that maybe you got a hold of your credit card number and ran up $5,000 worth of charges, and you had no idea. Or could be maybe the bookkeeper, got a hold of your credit card number and decided to have an early Christmas present, right? So these are the sorts of things that you need to know. And it is important to recognize that too. You don't necessarily want the same person who's in charge of your purchasing to also be the same person that is going to be doing the reconciliation. And that should be pretty obvious, right? So in other words, if you've got someone that is doing, let's say that they do the purchasing and all of a sudden they decide they want to go buy something on eBay for $300, they can very easily misclassify that. They can very easily say, oh, that was for the lumberyard, or oh, that was for medical supplies, or that whatever the business is, right? And they can misclassify that. And if you don't ever see the statement, you would never know. So it's really important to have a separation of duties. And I know as business owners and especially entrepreneurs, you cannot wait to turn things over to people. That would probably be something you just have to make sure that you don't turn over to someone else. Like if someone else has a credit card number where they can buy things or pay bills, like my bookkeeper does not have access to the credit cards. She has access to the credit card statement, but she does not have purchasing power. And that's really, really important, because if she had purchasing power and she was also the one reconciling the accounts, who would ever know? Who would ever know that fraud would happen? And that's actually something called an audit risk, where you may never find out that stuff is missing because they're burying the transactions. So what I'm saying here is, when you're looking at the balance sheet and the income statement, these are the sorts of things that you have to start to consider. And especially when you're looking at purchasing a business, right? You have to understand this financial piece. So the balance sheet is really, really important to know that piece of it. So if you're just joining us, it's good to see you. Go ahead and let me know where you're from. And so let me get my giant head out of the way here for just a hot second so you can see. This is the balance sheet here, and that is what you'll see is, again, the assets at the top, liabilities in the middle, and then of course the equity, the liabilities. The total liabilities, and then you've got the equity down at the bottom. Oops, so you know what? Let me take that banner down because that is getting in the way and being obnoxious. Okay, so you've got that right there. So the liabilities down at the bottom is the total liabilities, and then the assets minus liabilities equals the equity. So you've got the 400,000 in total assets minus the 190 or so thousand in total liabilities. Then you've got the total equity of 228 down at the bottom. All right. So that is your balance sheet. Your assets and liabilities. All right. So let's go over to here. Let me there we go. So I'm going to show you demonstrate what the assets look like. And this, keep in mind, this is a very, very simple balance sheet. So this is not meant to be super complicated, just so you can understand for the basis of learning. So your assets that are going to be listed, this is all the stuff that the company owns. So you own your cash in your checking account. So that might be, say, with USAA, that might be with, if it's your personal account, it might be with Chase Bank, it could be with Barclays, whatever it is, that is the cash balance in your checking account. Then you have your accounts receivable. That's the money that is due to the company. So your accounts receivable is really, really important, because if you're not paying attention to your accounts receivable and no one's really doing any real collection, then that can become a real problem, because the accounts receivable is just going to continue to grow. And that's not real money, right? It's just what someone owes you. So even though having accounts receivable isn't necessarily bad, I mean, it's a good thing if you're selling to your buyers on credit. You're basically, the company, are extending credit, and you're kind of acting like the bank. Well, you want to get that paid back to you, right? So let's say, for argument's sake, that 101,000, that's let's say 50,000 of that is one vendor and 51,275 is another vendor. So you want to get that money collected so you can put that cash in the bank. And the longer that goes on, by the way, that becomes a real problem. I'm not going to get into super weeds on that, but that's really important for you to understand in terms of accounts receivable. So if you have accounts receivable and people that owe you money, I would want to know how old those accounts are. And that's something called an accounts receivable aging. So once I see the accounts receivable aging, and if I start to see a lot of accounts over 60 days, 60 and 90 days, I'm really going to be suspect of that. If I see anything over 90 days, I'm going to be very, very concerned with that. Like, in fact, I wouldn't even give that any valuation. Not that it doesn't necessarily have value. They might say, oh, that's Bob's account. Bob always pays, but he just takes forever to pay. Yeah, that's great. But what if Bob dies? What if Bob eventually just can't keep juggling the chainsaws and one day he winds up hacking his arm off? I'm just saying there's real risk in allowing people to operate that way. So your accounts receivable, you've got to be on that like a damn Band-Aid. You can't let up in your collection efforts. And if you just kind of let your people pay whenever they want to, that can become a real problem in your business, especially when when cash flow gets lean. And if they're running like 60 and 90 days now, when the economy is running along pretty decently, what's going to happen during the recession? They're going to be the first ones that are going to have to shoot the horse because they can't afford to feed it. So I'm just saying, like, you got to be really careful with that sort of stuff. So you got your cash balance, you got your accounts receivable, and when it's listed on your balance sheet, it goes in order of liquidity. So your cash balance is at top, then it goes your accounts receivable, then vehicles, then real estate, right? So that's the most liquid to the least liquid. So in other words, how quickly could that be converted to cash? So your vehicles, for example, your vehicles are really important assets, but they're listed at book value. Meaning that they're listed at the price that you initially paid for them. So if you paid $29,970, it's going to sit on your balance sheet. And then what will happen is they're going to create an account called accumulated depreciation. And you're basically going to accumulate the amount of depreciation over the expected useful life of that vehicle. Let's say it's 7 years, right? So in straight line depreciation, I'm just going to do the math real fast. Is we'll say 29,970 divided by 7, so roughly $4,281 each year is going to be deducted or expensed off as a line item, right? So that way it's basically you're going to allow that accumulated depreciation to accrue. And then at the end of the 7 years, basically the useful life of that vehicle has been extinguished, right? So I'm just saying, like, this is all stuff that you're not going to see on this version right here, only because I'm not trying to get super fancy. I just want you to have a very basic understanding of a balance sheet. So when we're looking at company valuations, it's going to make more sense, right? So right now we're looking at some valuations like, okay, hey, the company looks pretty decent. Like, it's got a little bit of cash in the bank, not a lot. It's got 100,000 in accounts receivable. That's okay. It's got a van. Okay. So it's owned this van, however long it's owned the van. You don't really know. I mean, 2019, that's 6 years ago. So is there any value left in this thing? Then you've got the real estate in the warehouse, which is a $275,000. That would also be put on at cost, right? So whatever the purchase price of the real estate, if it was held in that company, then you've got that. So that is the assets part of the balance sheet. So now let's look at the liabilities part, which is the middle part. In the liabilities section, you've got things, again, it goes from, so basically from shortest term debt to longest term debt. In this case, you've got credit card debt, which is in the amount of $34,000. You've got payables due to your vendors. So let's say again that you're a home builder, right? If you're a home builder, then your vendors might be your electricians and your drywallers and your painters, right? Those could be vendors that they have sent you an invoice and you haven't paid it yet. So that's another thing you'd want to say, like, are you paying your vendors on time? And if you're paying them like net 30, like they ask, and you might be going over like 30 or 35 days, that's fine. But you got to keep your vendors happy. And you want to keep your vendors happy, pay them quick. That's pretty straightforward. The Wells Fargo, so on this particular example, there's a van loan that is due to Wells Fargo, and it's down to $11,570. So it sounds like you probably either didn't borrow that much for the van, or it's probably been out there for a while. And then the last one is the Citibank. This is the real estate mortgage on that warehouse that you purchased, and that's in the amount of $105,000. So all of those debts added together, everything, these are the balances of what is owed. This is the liabilities that are added together of just 189,000 in total, just over 189,000. And now what you would do is subtract the amount of the assets. And what are the amount of the assets? Total assets 417,000 minus the 189 equals to 27, just under $228,000. So that's the equity value of the company. So if you conceivably sold off all the assets and paid off all the liabilities, that would be what the company is worth. That's what you'd have left over. Okay, so generally, companies are worth more than book value. And the reason for that is because it forecasts things like growth, and it forecasts things like, like in this particular example, because the warehouse is in the amount of, let's say, $275,000, because the warehouse is worth $275,000, it's able to produce an amount of income out of that $275,000 that's far in excess more than what it's worth. Okay, that would be like if you owned a 3-bedroom house, and that 3-bedroom house is worth, say, $300,000. Okay, and let's say, for argument's sake, the long-term rental market, you're just going to rent it out as a rental. And that $300,000 house, say, maybe brings in $2,700 a month in rent. Okay. Now, therefore, if you're going to buy it as an asset for a long-term rental, it doesn't really make sense. You're not going to get a great return on equity for that. But let's say, for argument's sake, you don't operate it as a 3-bedroom house. You operate it as a room split, where you just rent the individual rooms, right? So now the asset isn't worth, $300,000. It could be worth $500,000 or $600,000, because you're getting not just say $2,500 a month for the entire house, or $2,700 a month, whatever I said before. Now you're getting like $1,500 a bedroom. Oh wow, that's a lot more, right? So you get $1,500 a bedroom. So now you're getting $4,500 a month, not the $2,700 a month, and now that asset is worth significantly more, right? So, but even though on the market you go, well, yeah, but I can't justify paying more than $300,000 for that house, because intrinsically it's just not worth that, right? Do I want to risk it and pay more to buy the box and hope that I can continue on? Well, that starts to get into different conversations. That's when you start to value things a little bit differently. All right, so that's where, let's take a quick look. We looked at balance sheet. Let's take a quick look at the income statement. So the income statement is the revenues, expenses, and net income. So the revenues, and again, I'm going to take myself down here so you can see this, but the revenues, again, is on the top part of that screen there. So if you see the revenues at the very top and the middle section, let me just go ahead and take myself down so you can see this a little bit easier. Okay, so you see that that section all the way at the top, that's the revenues, then the expenses, and then of course the net income. So let's get to, and I'm going to show you what this looks like for the income statement. So the income statement here, these are it's breaking down the revenues between product sales and service sales, and that could be any number of things. Generally, a company is going to have multiple streams of revenue that are going to come in, especially with companies that have been around for a while. They start segmenting themselves a little bit. They start differentiating themselves in the market, which is generally a pretty good thing. If you're differentiating yourself where it starts getting where your business starts getting too fragmented, that's not necessarily a great thing. But differentiation in the market is absolutely critical, because then you have pricing power. Then if you're the only, let's go back to that example where you had this $300,000 house and you were the only house in that entire neighborhood that was renting by the room, where you were able to charge $1,500 a bedroom for the entire month. And if you're the only one that's doing that, then you have pricing power, right? You've differentiated yourself from the typical housing market. And let's say, for argument's sake, that you might say, well, why would anybody pay that? That exists all over the place, those sorts of situations. You just got to know what you're looking for. All right, so we've got the revenues up the top there. Again, it's broken out between product sales and service sales. And if you see that percentage that's next to the revenues part there, that's really important, because the revenues, as the reason why they would be split out is because the 65.8%, where it says 65.8, that's 65.8% of the 114. So in other words, 75,000 divided by 114, that's 65% of the total revenues. And then the service sales is 34% of total revenue. So that's why it's really important to break those things out, because if you know that, let's say for argument's sake, that product sales has way better margins than your service sales, you would want to maximize as many product sales as possible, or vice versa, depending on, whichever one had higher margins. So this is where you start to promote things in a different way. Let's take a look at the expenses. So if you look at this again, I'm going to take myself down here so you can see this. And those percentages also are really, really helpful when you're comparing similar periods. So in other words, if you were going to compare, let's say, November of this year to November of last year, that would be really important to know. Or November of this year and October of this year, right? You can see month-to-month comparisons as things were happening. So this would be really important. Now, you've got to be a little bit careful about comparing too many things that are unlike. Like, I wouldn't necessarily want to compare February of this year to November of this year. It doesn't make sense. Like, the buying cycle is completely off. Everything's different. So I might compare month over month, like October to November, and I might compare the same month, year over year comparison, November and November. That would make sense in terms of how I was comparing those. And the reason why those percentage numbers are so important, let me just show you here, is when you're looking at these numbers. So for example, let's say that total sales actually went up, but because sales went up, that so did raw materials. So if total sales went, say, to 150,000 and raw materials went to 40,000, well, the math on that is really important to know. So let's say in this case, we've got 40,000. So we got 40. My calculator doesn't want to work all of a sudden. So in this particular case, I've got 40,000 divided by the 50,000 in sales. So my raw materials as a percentage of sales actually went down. It went to 26%. So that's actually not a bad thing. Like, I'm becoming more efficient with my raw materials. So if my raw materials went up and the total sales, if the total sales went up to 150,000 and raw materials went up to 40,000, if you only looked at the raw numbers, you might freak out and go, oh my gosh, what happened? My raw materials expense has gotten way out of control, right? Well, not necessarily. When you use the comparison based on percentage of sales, you can see that the percentage of sales actually went down based on a total number of sales. So that's actually a really powerful technique. And that's actually, by the way, what chief financial officers, CFOs, financial analysts, that's what they're all doing. They're comparing those numbers just like that. So again, now let's say, for example, let's keep doing some of the math here. Let's say the sales went up to 150,000 and And it does not want to play well with me today. So let's say for argument's sake, it went up to 150,000. What is the deal here with my calculator? Does not want to work nice. Let's see here. Well, I was going to do it. Here we go. I'll just do it on Excel. So let's say it went up to 150,000 and again, 40,000. So I've got 40,000 divided by 150 is going to be 27%, 26.7%. If I went to 150,000 and my raw materials went up to 45,000, that's going to put me at 30%. So now you're thinking, okay, well, now it's more. Now I'm less efficient at using my raw materials to create that higher level of sales. So is it something to worry about? No, not necessarily, because it didn't go up that much. It went up a little bit, but that could just be normal inflation because it'd be, different buying patterns or whatever. But if it shot up to 35% or 40% of sales, then I'd be really concerned. So it just depends. It just depends on what it is you're looking at and what your metrics. Generally, your things like raw materials aren't going to change that much unless there's lots of price fluctuations going on in the market. Like right now, metals are like going crazy, especially copper. So if you were a home builder or if you were in plumbing or if you're in HVAC and you've got anything to do with copper, like your raw materials are so hard to price right now. That's really, that can be a real problem. But generally what most people are looking at are things related to their wages. And that's generally going to be the biggest line item expense. So most people are going to be looking at wages. And that's probably the biggest thing that you can control most directly is how much time, how efficient people are actually running in your business. So that's where, in this particular case, again, let me take a quick look at this, is if you're looking at wages, because wages are almost very consistently the biggest expense. So in this particular case, again, looking at 114,000 in sales, the wages was basically just under 45,000. That's at 39% of sales. So in other words, if you went up to 150,000 and in sales and you had, let's see, you had 60% or $60,000, now your wages would be at 40%, and 40% is pretty much on par with the sales increase. So I wouldn't be freaking out. But again, if I'm looking at a sales increase, let's say you went to $150,000 in sales and you had 75,000 in wages, now your wages are at 50% of sales. And that would be a big problem. Like wages are out of control. Now, you might be thinking, well, why is there so much? Is it because of increase? Is it, was I working my sales guys like crazy and I had to commission them more? Was I working my sales guys or my marketing guys a lot more, and were the production guys doing a lot more because there was more sales, where there was a lot more overtime? These are all things that you just ask. So it doesn't necessarily mean it's bad by itself, but you are less efficient at making and keeping dollars. And that's why it's important to know and use that metric. That percentage of sales metric is so powerful because you can then compare apples to apples. You're always comparing the percentages, not necessarily just looking at the raw numbers. Okay, because the raw numbers don't tell you the whole story. All right, so that is the income statement. So the next thing here, this is the expenses, and the expenses we kind of talked about already. So we talked about the balance sheet, talked about the income statement, in terms of the revenues minus the expenses. So what I'm going to show you here real quick, and this is all coming off of the seminar that I do, the financial literacy piece, is, why does this even matter? So I just want to show you really quick. And what this does, let me see if I've got this. I don't know that I actually have this in. Here we go. So what I'm going to show you here, give me just 1 second, because I want to show you what EBITDA is actually calculating back. So what you're doing is to calculate EBITDA, you're going to take your interest expense and your tax expense, any depreciation expense or any amortization expense, and you're going to add that back to your earnings. So in this particular case, we see how there's $17,000. Let me again take myself down here. You got $17,000 in earnings. You're going to take that number and you're going to find interest. Okay, so your interest is right here. Is there any, you're going to add that back to the number. is there any, let's see, there's no taxes. Okay, so you're not going to add that back. Is there any depreciation? Nope. And is there any amortization? Nope. So really the only thing you're adding back to create EBITDA is just your interest expense of $2,450. So that would be just roughly what, about $20,000 altogether is your EBITDA number. So you might say, okay, great. Now, one quick thing I do want to make a point of is that if you've got something that's an operational expense like property taxes, that would not get added back. Property taxes are a direct expense of owning the building. We're talking about a non-cash expense, which would be taxes that you would pay to the feds, right, or the state. So talking about income taxes. So that's different. The property taxes, you're going to pay property taxes regardless if the building is profitable or not. Like that's just part of an expense. You would not add that back. So one quick thing on depreciation and amortization, like what's the difference? Because people think that depreciation and amortization are like basically the same thing. They are not the same thing. Depreciation is the writing down of a physical asset. So again, you own that building minus the land. Land cannot be depreciated or is not depreciated. So you would depreciate in this particular case. Let's say that you've got $1 million building, and the useful life of that building, generally, if it's a commercial building, is going to be over 39 years. So, you would divide that out by 39. If it's a residential property, 27.5 is generally the number that you're looking at. But really, it just depends. It just depends on the asset. But in this particular case, that's depreciation of a physical asset. Amortization is the writing down of a non-physical asset. That might be a thing like a loan. It could be a thing like a patent, right? Those are things that are written down over the course of time. So if you think of like an amortization schedule of a loan, that's why it's called amortization and not depreciation. So fun fact. All right. So those are all the things there. This is all the stuff that you're going to need to know in terms of calculation of EBITDA. All right. So now you might be saying, well, why do I care about any of this? You shouldn't really care about any of this stuff right now, because at the end of the day, if you're trying to calculate EBITDA, that's the number that you're going to use in your valuation. So let's pretend in this particular case, again, let me go back and share my screen. Let me go back to the balance sheet for just a second so I can show you what I'm talking about here. And there's a significant difference between the valuation on a balance sheet versus the valuation on an income statement when you're calculating EBITDA. So in this particular case, you've got, okay, so there's the balance sheet. Or I'm sorry, that's the income statement. Let's go to balance sheet. Boom, boom, boom. There we go. All right. So now, like we discussed earlier, let's say that our EBITDA number is 20,000, right? We took the earnings of 17.6. We're adding back the interest of $2,400. Generally on this though, we're going to want an annualized number. So let's pretend that income statement was an annualized number. If it's a monthly number, you would want to make sure that represents an annual number. Otherwise, you're not. Generally, EBITDA is going to be viewed over the course of 12 months, not just the course of a partial year or 1 month or anything along those lines. So you want a full year's earnings to calculate to use the multiple to come up with a valuation. So in this particular case, let's say that it's $20,000 over the course of a year. It's pretty low, right? So you might be thinking, okay, well, in this particular case, the valuation of the business, if I bought the assets and sold off and paid off all the liabilities, the amount based on the balance sheet that I would have would be just under $250,000, $227,000, $228,000, rounded up. Okay, so it's worth $228,000 on paper. All right, so what if I was going to do a different valuation based on earnings? Okay, so in this particular case, it's worth $20,000 in earnings. And let's say that you were selling the businesses that were similar in that particular type of industry were typically being sold for a 9 multiple. So you might be saying, well, what's a 9 multiple? It's pretty straightforward. You're going to take that earnings number and multiply it times 9. So let's see if my calculator is working again. So in this particular case, you've got 20,000 and you're going to multiply it times 9, which of course is $180,000. So if that was very typical, you might say, okay, well, I'm going to pay $180,000 for that type of business. And you might say, well, is that a good deal? Well, if the true valuation of the assets are assets minus liabilities is 227,000, and I can buy that business at a 9 multiple, and that means that that the revenues might be arbitrarily low, or the valuation of the assets might be higher than what they truly represent. I mean, there's questions there, but generally that sounds like a pretty decent deal. It sounds like you're buying 227,000 for 180,000. If you were just going to go in and liquidate, you're going to be this corporate raider and go buy this property or buy this business and sell off all the parts and make a profit between 180,000 and 227,000. Conceivably, you probably wouldn't make any money on that reasonably because of commissions and taxes and all that stuff. But by the time you probably would break even if you were lucky. But let's say that the multiple was more like a 4 multiple, and you'd say, okay, well, reasonably for this type of company, that it's 20,000 in EBITDA on a 4 multiple. Now you're looking at $32,000. Okay. Or I'm sorry. I'm not going to do this math in my head. It's too late in the day, but nope. So 4, right. So we're doing 4. Why is my, oh, I know why. So in this particular case, right. So you've got a $20,000, so that would be $80,000, right? So now you're looking at $80,000 as a purchase price. So you might be saying, well, that actually kind of does make sense. Like I could get behind buying or paying $80,000 for a business that is going to be worth, if I sold everything off, going to be worth $227,000. That might make sense. So this is why it really matters for you to understand EBITDA when you're actually looking to sell your business or buy someone else's business. That's a big deal. That's really, really important. So this is where you start to do the calculations and start to make sense. Now, generally, this is not the case. Almost always, the people want the seller of the business is going to value their business way more than what's on the balance sheet. Almost universally. That's just crazy to think that they're not going to value it that way. So that's why you have to understand the difference between the income statement and the balance sheet and how to calculate EBITDA. So once you calculate EBITDA, then you have that number. Now, there is something that I mentioned earlier, and I'll just make this last point, and then I'll put the fries in the bag on this particular video. But the interesting thing around this is sellers' discretionary earnings, right? Seller discretionary earnings. That's known as SDE. And I've seen where businesses get valued based on SDE and not EBITDA. Again, it's going to depend on the business, but it's basically what the earnings are net of all the stuff that the owner is taking out of the business. So I'll give you an example. It's pretty common for business owners to run things through their business where they can get away with running things through their business. For example, cell phones, right? They have their business pay for their cell phone. That's pretty typical. They have their business pay for their gas and their fuel, right? Or maybe new tires for their car, especially because they might use the bulk of that vehicle for business, right? So again, I'm not going to tell you about the ethics of that. That's up to you to decide if you're going to do that or not. I generally, like, my vehicles are owned by my holding company. So there's no question. And I use it literally for only, for business. So it's pretty straightforward. And if I'm doing any travel, I actually rent vehicles. So it's pretty straightforward. Like it's clearly a business expense. But if I was going to own businesses, like, or if I own vehicles, now I don't own the vehicles, but my holding company owns vehicles that the property management company uses, and it's only used for business. It's pretty straightforward. Like there's clearly expenses that are in there, but people will sometimes do that. They'll run medical expenses. They'll run all sorts of expenses right or wrong, I'm not here to tell you. I'm not the morality police or the tax police, but I'm just saying that that's typically what happens. So what they'll do is they'll call that seller's discretionary earnings. So they'll add back stuff like this. And it was kind of funny. I was talking to a business broker the other day, and there was a line item on there that said, like, I don't even know. We'll say it was like $50,000, and it had this weird classification to it. It said like Jessica, right? $50,000, and the business broker was like, "What's this Jessica expense?" He's like, "Oh, that's my mistress." Oh, so we're gonna assume that the mistress is not going with the business, and he's like, "No." Okay, so I'm like, "Okay, so we're gonna take that off the balance sheet." So that would be like an example, a horrible example. Well, non-ethical example, good example, but horribly unethical of what could be considered a seller's discretionary, earnings. So that's why I'm saying, like, those sorts of things would get added back. And that is also where EBITDA and SDE, seller's discretionary earnings, would probably vary. And if it varies a lot, there's some real questions that would come up, is saying, okay, well, how much of this is really there? Like, how much of this is going to be contingent upon the normal operations of the business? And generally what I have seen is the more seller's discretionary earnings, and I can't say this across the board, but the more SDE that there is, the more valuation tends to get inflated, because the owners got to replace, they're not going to give up their cushy income, and they want a good payday. They want a fat payout, because they've got this standard of living that they've grown accustomed to. So generally, the more of a variance between SDE and EBITDA, it tends to be more difficult to get an actual deal put together. I mean, what is that number? I can't say if it's 50% more or 75% more. I'm just saying, like, that's a real problem. That can become a real problem. All right. So that is all that I've got on this. For those of you who are interested and stuck around, thanks for sticking around. Hopefully this was helpful for you. And I'm going to go ahead. This is the school community. If you've got some specific questions around this, I will answer. I answer the paid members and premium members and VIP members first. So no disrespect to you, but I focus in on them. And this is the sort of stuff that I talk about all the time. And we go through this stuff in the actual boardroom, where people have specific questions on this. We hop on a call, and you've got specific questions around these various things. This is the sort of stuff that I'll go through with you if you've got different things. Now, if you're bringing me, just understand, if you're bringing me something that's going to be where you have signed an NDA, I'm not going to look at it, because that means you're violating an NDA. I would also have to sign the NDA, and I'm not about violating that on your behalf. So we just need to make sure that we know, everything that we're looking at. If it's your stuff and you don't have a problem with other people taking a look at it, I've had people put their balance sheet and income statement out there, and we can all figure out, we can all learn from it. And it's very, very helpful for people to learn that way. All right. That's all I've got, everybody. Have a great rest of your day, and we'll see you guys next time.